You ever see a tiny startup with a cool idea, and then bam, suddenly they're a global giant? Well, you know it's not magic, it's money. We're talking millions, sometimes billions of dollars. But where in the world does all that cash come from? Today, we are pulling back the curtain on exactly that, how companies raise the capital that turns those bold ideas into the household names we all know.
Right. This is the fundamental question. It's about that incredible journey from a garage to the stock exchange. It's the huge leap that transforms a founder's dream into a public company. And right at the heart of it all is one single critical challenge: raising capital.
And that's going to be our focus today, this high-stakes quest for capital. You know, it's a journey that's filled with powerful investors, really complex rules, and decisions that can literally make or break a company. So let's dive in.
And look, this isn't just about getting a check in the mail. This is a fundamental fork in the road for any business. One path leads to the bright lights and hustle of the public market, and the other leads down the quieter, more exclusive hallways of private investment. The choice a company makes right here, it defines their entire future. So, let's start with the one that gets all the media attention, the IPO, which stands for Initial Public Offering. The best way to think about it is like a company's big opening night on Broadway. It's their grand debut on the world's financial stage. So what exactly is an IPO? Well, in the simplest terms, it's the moment a private company, one that was owned by just a small group of people, decides to sell little slices of itself. We call them shares or securities to absolutely anyone. The gates just swing open, and the public is officially invited in to own a piece of the action.
Now, to really get a handle on all of this, you only need to ask two simple questions no matter what kind of offering we're talking about. Let's start with the most important one. When all those shares are sold, who gets the money?
For an IPO, the answer couldn't be clearer. The money flows directly into the company's bank account. This is what we call a primary market transaction. It's brand new cash that's meant to fuel growth. We're talking about money to hire more engineers, build new factories, or expand into other countries. But you can't just wake up one day and decide to list your company. Not even close. To protect the public, the Securities and Exchange Commission, the SEC, gets involved. A company has to file mountains of paperwork, including this really critical document called a prospectus. Think of it like the company's tell-all biography. It has all the financial details, the business strategy, and, most importantly, a very long list of everything that could possibly go wrong. And that right there is why, for investors, IPOs are such a gamble. You're often dealing with a young company that doesn't have a long track record. You aren't buying into a history of proven success, you're betting on a vision of the future. It's the ultimate high-risk, high-reward play, for sure.
Okay, so the company did it. They've gone public. The confetti's been swept up, but the story doesn't end there. What happens when that company needs another injection of cash? Or what about when the founders and the early employees want to finally cash in on all their hard work? Well, that's where secondary offerings come into play.
And right here, we hit a super important distinction. In one type, called a primary offering, the company itself creates and sells brand new shares to raise more capital, so that money goes right back into the business. But in the other type, a secondary distribution, it's not the company selling at all. It's the existing shareholders, founders, early investors, selling their own shares to the public. In that case, the cash goes straight into their pockets, not the company's.
But what if a company wants to raise millions without all the bright lights and the intense scrutiny of the public market? Well, there's another way. There's the private path. This is a much more exclusive, kind of behind-the-scenes way to get funded.
This is what's known as a private placement. So instead of shouting from the rooftops in a public offering, the company quietly negotiates a deal directly with a small, hand-picked group of investors. It all happens behind closed doors, totally away from the frenzy of the stock market. And because these deals are private, the rules are totally different. Under something called Regulation D, they get to skip that full, expensive SEC registration process. But there's a catch. This exclusive path is usually only open to what are called accredited investors. These are basically wealthy individuals or big institutions that the SEC assumes are sophisticated enough to understand the risks and can afford a potential loss, so they don't need the same level of protection as you and me.
But this exclusivity comes with a pretty big string attached. The shares you buy in a private placement are restricted. What that means is they're locked up. You can't just turn around and flip them on the stock market the next day. There are specific rules, like Rule 144, that spell out exactly how long you have to hold on to them before you can sell.
All right, so we've covered the bright lights of an IPO, the follow-up act of secondary offerings, and the quiet backroom deals of private placements. Let's put it all side by side on one simple cheat sheet just to make it crystal clear. Here's the breakdown. Just look at that who gets the money column. For IPOs and primary offerings, the money funds the company's growth. But in a secondary distribution, it's insiders cashing out. Then look at who can invest. The public markets, open to everybody. The private path, an exclusive club for accredited investors. Honestly, these two columns tell you almost everything you really need to know.
So, if you only remember one thing from all of this, let it be this. Anytime you hear about a company raising money, just ask yourself two simple questions. One, who gets the cash? And two, what are the rules of the game they're playing? Is it the open, public rulebook or the exclusive, private one?
And that really brings us to the fundamental trade-off at the heart of all investing. On one side of the scale, you've got safety through regulation. On the other side, you've got opportunity through exemption. One is there to protect your money, the other offers the chance for it to grow like crazy. So as an investor, the ultimate question really is, where on that scale are you willing to stand?